Sarah Larby, guest host of The Everyday Investor and producer. I'm really excited for an amazing show, but before we get into that, keep in mind we work hard, but we want to have something at the end of the tunnel that's not going to require 30 plus years of work. So start investing early, make the right moves, be strategic, take action, and you can retire. I retired in 7 years, and you can too by doing the right things every single day and watching the right show. And I want to say thank you for tuning in, and don't go anywhere. We've got a special guest today. We'll be right back. Today, I am speaking with James Lloyd from US Properties, discussing how to invest in the US as Canadians.
And, as a Canadian, if you're looking to invest in the United States, one of the first things you really want to look into and ask about is how you're going to hold these assets correctly for liability and taxation reasons, right? If you do it incorrectly, you could potentially have some issues on your plate with double taxation. If you do it correctly, you won't.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Sarah. Welcome back. Before we talk to my good friend James Lloyd, let's see what's happening in the world of stocks with Omar Khan. Omar, over to you.
Thanks, Sarah. Omar Khan, guys, here with Data Trading Weekly Market Update. Now, the markets pulled back a little bit last week because of this nasty word that keeps coming up, inflation. I'm sure you've seen it in the grocery stores, out and about. You're probably seeing prices go up. Now, inflation is not the best thing when it comes to the market. Stock market gets a bit worried because future expected growth could be expected to be lower because central banks would have to raise their rates. Now, I don't want to get too much into what that means. Basically, the fear is interest rates could go up, therefore slowing down economic activity. What's happening right now, though, is that corporate earnings, the amount of money companies are making, are still coming in very strong. So the market keeps pushing all-time highs. Now, that will continue, but we're going to have to keep an eye on this nasty thing called inflation and to see if corporate earnings keep coming in. So far, so good. And we're about to enter the good part of the year statistically with November and December, which is supposed to be a really good time of the year for the stock market. So let's see what happens.
Thanks, Omar. That was awesome. James Lloyd, welcome. How are you?
I'm doing really great, Sarah. It's a pleasure to be here. Thank you for having me.
I am super excited. You have built, a really awesome portfolio. You've helped many investors along the way as well, and you are investing in the U.S., but best of all, you are Canadian investing in the U.S. How did you get started with that?
My lifelong friend and company president, Wojtek Mardula, was a Canadian real estate investor. And about 5 years ago, he was lured to Detroit because they were looking for what most Canadian investors are looking for, which is more cash flow and affordable acquisition. And, after he got down there and actually saw the product and saw the neighborhoods and the homes and started to purchase, the plan really started to form this company, US Properties. From there, I came in as the sales manager to alleviate some of the stress and workload for him and be with the client base. And, from there, we started to go to Detroit regularly. We saw the transition of the city. We started to acquire. And from there, it's just grown into where we are today.
Awesome. So let's just say, there's somebody at home wanting to invest in the U.S. Let's talk about some of the things that you've learned along the way and that we should know as Canadians investing in the U.S. market. So maybe let's just start with financing. How does the financing piece work if I wanted to go buy something in Detroit or Florida or whatnot?
Well, in Detroit, the lenders are a little less favorable than they are in the South. The U.S. lending system is asset-based, right? So what does that mean? That means that, they really want you to have an established asset that you own outright so that you can leverage it. And then if you default, they can lien against it, right? So it's a little different than here. Like, for example, when I went to Detroit 5 years ago, I was James from Canada. I didn't have a social security number or a SIN, so I was a little bit of a liability to lend to. What most of our investors do is they come down, they'll buy the first property, just the first one with money from Canada, be it a HELOC, a JV, a refi of a property here. They'll own that asset outright. And then now the lenders will work with you all day because you can refinance the property after a 6-month period, pull equity out and scale, and they're happy to do that because you own the asset and it's asset to start your acquisition process from there on out.
Okay, and obviously, you know, you're an investor as well.
Yeah.
You're not necessarily a mortgage broker or a lawyer, but you
Right.
have a lot of experience doing this. So, you know,
Right.
thank you for sharing that. So, from a financing standpoint, then it sounds like you know, it's cash up front. You set yourself up 6 months down the road. You have a little bit of credit built up, and then you can go ahead and refinance with a bank that's down there. What about in terms of the legalities and the differences, right? Because you think a lot of what they do in the US and it's LLCs and they set up these you know, LLCs pretty much for every single thing that they have. I don't think that's the same thing here, but you know, please educate us.
It's a great question. You know, as a Canadian, if you're looking to invest in the United States, one of the first things you really want to look into and ask about is how you're going to hold these assets correctly for liability and taxation reasons, right? If you do it incorrectly, you could potentially have some issues on your plate with double taxation. If you do it correctly, you won't. So a lot of due diligence and work was put in when we first started doing this 5 years ago through Pamela Wojtek's wife, who's a career attorney. And there's a structure in place that we've used hundreds of times. You know, we have attorneys, US-based attorneys that can help our clients. You know, the nuts of it are going to be that you form a limited partnership, right, which is an entity with an LLC as the general partner. When these two entities work together in harmony to own your asset or assets, you get the benefit of some pass-through taxation between Canada and the United States. We have some great documentation on it. You know, there's been countless investors who have sent the structure out to their attorneys to review, and it really does work. You know, as the sales manager for the company, I deal a lot with the front end and our client base. And I must say that nobody's ever emailed me and said, you guys were wrong or had issues with taxation. So we have that really figured out. And it's a very powerful piece and very important for our investors to get set up correctly. From there, you know, we get you a bank account set up with the same entity. We can get you lending, as you mentioned, down the road, all the way through the entity. So it really is an important piece of the puzzle, and we have that all set up for our Canadian clients.
Okay, awesome. Now, I just want to, you know, make sure that somebody that wants to go out and buy something in the U.S., whether it's, you know, through, you know, a different company or by themselves, why Detroit? Why did you go into Detroit? And what are some of the things that, you know, if they wanted to go start looking in Detroit neighborhoods or whatnot, what are some things to keep in mind when you're purchasing?
You really want to be in the right areas of Detroit. Okay, well, why Detroit? Detroit obviously went through some hard times, as we all know. It went through the largest federal bankruptcy in U.S. history. But from there, there was a massive bailout by the U.S. federal government for $8 billion, and a large amount of the private sector, gentlemen like Dan Gilbert, who owns Quicken Loans and Rocket Mortgage, and the Illages, who own Little Caesars Pizza, started to pump in billions of dollars into downtown Detroit and rebuild the sports arenas, help with the public transportation, the schools, the park, the major infrastructure, and the arteries that run out into these neighborhoods where we acquire properties, okay? There are underlying historic districts of Detroit that have beautiful colonial homes on tree-lined streets that you know, would be easily $1.5 to $2 million in cities like Toronto, that you can go in and acquire these properties at a fraction of the cost as you would in Canada. Okay, this gentrification and investment that has gone into the city has really you know, sort of bled out into these neighborhoods, and there's just been one of the most amazing renaissances and recoveries, you know, since really the Great Depression. Okay, if you are looking at the city of Detroit, you really want to latch on to somebody like ourselves who has experience, because I can tell you there are areas of the city that you still do not want to go to. It doesn't take much to go from good to medium to not good, all within a short perimeter of time. So if you don't really know who you're dealing with or where you're going, certainly it's easy to buy inexpensive property. The key is to buy, you know, inexpensive property that has upside potential and also has established infrastructure around it that's going to enable it to be a sound investment. And you really need the boots on the ground, because I can tell you, if I didn't have the company that I work with when I first started going down there, I wouldn't know or have that information on where to invest and where not to. And it's going to make all the difference in things that we'll talk about as we go on today, with appraisals and being able to refinance and have success and long-term appreciation growth.
And you know, here's the thing is lots of people are going to watch this. Some people might reach out to you. Some people might want to say, I want to do this by myself. So who are some of the team members I don't need names of course, but like in terms of like roles and who you want to have boots on the ground wise, who are some important key people to have so that you can invest, being a Canadian in a US market, whether it is Detroit or somewhere else?
Property management for sure, right? So a huge part of what we do and what we can offer, I'll say this about our company, but this is what I think most people should be looking for is a team that gives so much value to the clients, right? So we have everything from property management to construction to the legal department, but if you want to go into a city and buy remotely, especially if you're going into the United States, you need to have a really good property management team. It's going to make or break the investment, right? I hear countlessly when I speak on phone calls with Canadian clients that they're struggling with property management even within Canada. When we first started down there, we outsourced. It really became very apparent early on that as we grew and wanted to grow, we wanted to be able to micromanage things like tenanting time and quality management. So we brought it in-house. And it's a lot of work. It's not the favorite part of what we do, but it's a very important part of what we do. And every piece of that puzzle is what makes this turnkey, makes it quite seamless and really a really good option for Canadians who otherwise might find it quite daunting and overwhelming.
Now you guys, I think, are doing the BRRRR strategy out there as a business. So that is buy, renovate, rent, refinance, repeat. My favorite strategy, definitely. And so what are some of the hurdles, if you don't mind me asking, being remote in the beginning that you faced, buying properties in the US, renovating them from afar, tenanting them from afar? What were some of the hurdles that you encountered?
The right contractors for sure. It's like anywhere, right? When we first started, we started with crews. And, if you want to do with this strategy that we're talking about, there's a recipe that has to be in place. You need to have the quite quality of property in the right neighborhood. It has to be a certain square footage, has to have the right number of bedrooms. It has to have the right level of renovation to it, that it puts a finish on the home that will enable it to appraise higher than what the purchase price is, right? So it is a BRRRR strategy. We do it a little bit differently in that you buy it actually renovated, right? Well, we help you with that. You're buying it under what the current market value would be. We're able to do that because we buy in bulk, we manage the construction. Again, that some of the hurdles were tenanting in a timely fashion, learning what causes these homes to pass code inspections to allow them to be tenanted and not continue to have them tripped up. You can renovate a home and do 98% of the renovation really great. It cosmetically looks good, but it may not have like the wiring and the electrical perfect or other components of the HVAC or whatever it is. It's going to cause it to trip up on inspections to allow the tenants to move in. It'll also be very regulated in Detroit. So we've gone through those hurdles. We really, as a team, have gotten together and learned, and we've grown. So it's a really good time in our development.
Amazing. Awesome. James, thank you so much for so much insight so far. Don't go anywhere. We'll be right back.
At Theta Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course, or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
Hey, it's Sarah. You are listening to Everyday Investor. We are going to be talking about the numbers and really digging into how to make money with specific deals. But before that, Kyle Ford on the mortgages. It's always important to understand financing. Kyle, what's new?
This week, I want to talk about one of my key philosophies in real estate. Don't wait to buy real estate and wait. That same philosophy holds true when it comes to private lending. Don't wait to private lend and wait. The income stream that comes from private lending can help subsidize lifestyle expenses, additional funds towards retirement, or just help pay those day-to-day bills. As the Christmas holidays approach, I hear many people say, well, I just got paid out of a deal. I'm going to wait till the new year to put it into a new deal. Though sometimes I understand that it feels good to have more money in the bank account. We funds invested throughout the holidays, throughout the years, regardless of what's going on personally, to make sure that income stream and revenue is constantly there to support you and reach both your short and long-term goals. If you're looking for quality private lending opportunities and secured mortgage positions, don't hesitate to reach out to myself and the Kyle Ford Mortgage team. Thanks, and back to you.
Thanks, Kyle. That was really insightful. James, we are going to dig through a real deal that you've done, and we're going to dig into the numbers. What is the deal that we're going to talk about today?
What we're talking about today is a very standard deal that's really become our sweet spot in our Detroit program, okay? So this would be a 4-bedroom, a colonial home in one of the B-class Detroit neighborhoods we talked about, okay? So we're able to sell a property of this nature at a full turnkey, fully renovated price of $145,000 USD in this case, okay? That's an all-in turnkey, fully renovated price. So the customer is buying it, obviously renovated with no additional expenses. It's ready to be tenanted.
Okay. So this $145,000 includes the renovations.
Yes.
This is something that you can get in Detroit. You said 4 bedrooms, brick outside, looks nice.
Yes.
That seems like a pretty good, pretty cheap deal in a sense. And some parts of Detroit, I guess, are a little bit more expensive or less expensive. So was this on market or off market?
It's off market. Okay. So we acquire off market properties. We buy them in bulk from, large portfolio owners, some U.S. funds. Occasionally we get them off the MLS, but not a lot. We get the property, and then we do the full turnkey, quite high caliber renovation to the property.
Okay, awesome. So this one, purchase price plus the renovations all in, it's something that you were able to offer to somebody who purchased it for $145,000. What are the closing costs on something like this?
It's about $2,000. In Michigan, you're going to close with a third-party title company. They're going to provide the things that you would want the surety with, like title insurance, warranty deed, land transfer tax. They're going to just, facilitate the transaction so that you, as an investor, know that you're getting a property that's free and clear and unencumbered. It's about $2,000 USD.
Okay, awesome. So essentially, what you do is you take these properties, you renovate them. What's the timeline between the time that you purchase to the time that you're done renovations?
It's a great question. So look, we acquire the properties, and then I put them on pro formas. We do a lot of due diligence on the numbers. We run everything by our Detroit team, our realtors. We get the ARVs. We know the neighborhoods really well. We then put them under contract. So if I showed it to a Canadian investor, or a Canadian investor is looking at a property, the timeline is we put under intent to purchase. As soon as they do that contract, a lot of clauses in it for due diligence, it's around a 6-week process, 6 to 8 weeks of renovation.
Okay, all right, 6 to 8 weeks, and then you find your tenants. How long does it take to find the tenants?
It's not long. So properties of this quality, of this, in these neighborhoods, we can usually have a tenant either lined up at closing or within about a week. From there, it has to go through some inspections to make sure that it's up to rental code. So it takes about a month to stabilize the property after close.
Okay, so 6 to 8 weeks, and then about another month or so. So something like this, what is the after repair value when the time essentially elapses and you've got your tenant in, you get your appraiser to come in, give you your new value? What was this one like?
This is great. So this is what we really aimed for. So there's a $30,000 lift. So it came in at $175,000 USD. Okay. U.S. lenders will allow Canadians to refinance an initial cash purchase within 6 months. It used to be 90 days pre-COVID. Then lending shut down. As you can imagine, we went through these difficult times. It's recovering now. Currently, it's 6 months. Hopefully, in time, it goes back to 90 days. Before they fund the refi, they send out the appraisal. And we're really doing a really good job of making sure they hit these numbers.
Yeah, that's pretty awesome for, just a couple months, essentially, $30,000 US lift, being able to do this from afar, not having to be the feet in Detroit on the street and just being able to invest a little bit more remotely, a little bit more passively, if you say. What about the cash flow? So once you refinance, you put a tenant in there, you've got obviously expenses, you've got the income coming in from the rent. What's the average annual cash flow?
In this case here, the annual case is about $4,300 after it's being leveraged. Okay, so unleveraged is obviously considerably higher, but you're throwing the mortgage into the equation here. Good news is that these properties in Detroit, once their leverage is a mortgage, you're still rolling around 450 to 400 US positive cash flow a month, depending on the property. So it's a strong market. You can refi, you can pull your capital back out, you can scale, and they're still cash flow positive.
Now, you've mentioned something I want to just clarify with everybody, leveraged and unleveraged. What does the
Right.
difference mean, just so everybody is on the same page?
Unleveraged is an initial cash payment, so you're all in. There's no mortgage, right? So you're netting the full cash flow profits, right? You still have some expenses for property management, obviously, and insurance, and some things you should put aside for maintenance and vacancy. But it's just that there's no mortgage on the property. Leveraged is once the refi has taken place, you've added the additional mortgage to the mix and to the numbers.
I see. Okay, so this $4,300 cash flow is leveraged. That means you have a mortgage on the property. You've got obviously your utilities. You probably have property management and a few things. But net $4,300 a year, US dollars in your pocket. And what was the typical appreciation or the annual appreciation on this deal, or similar ones?
On this deal, because of the neighborhood it's in, we're looking at around 15%, 10 to 15% annually. That's obviously not the case in all of Detroit. But as I was saying earlier, our experience leads us to only focus in about 10 core neighborhoods where it's really hot real estate, right? And in those neighborhoods, we've been enjoying 15 to even 20% in some of these neighborhoods for the last 5 years. Time will tell how long that will maintain itself. But this home right now is incurring about 15, let's call it 10 for this conversation.
Yeah, I mean, that's pretty incredible. It just goes to show you got to be very specific on the markets that you choose. Like I think you said in the beginning, you go to across the railroad or across the street, it could be a whole other ball game. And you might say this house is $30,000. That's great, but it might still be worth $30,000.
That's one of the best pieces of advice you could tell somebody who wants to invest in a market like Detroit, right? Is just be careful where you buy, because the price you can buy, it's really easy to buy inexpensive. But you really want to protect your investment, because there are a lot of places where it's just not going to be worth anything.
Yeah, no, absolutely. So you've got, you said 10%, so that's 17,000, and a half, let's just say, of appreciation on this deal. You could get more, but let's just stay conservative, 10%. And so you've got your cash flow, you've got your appreciation, and then what about the mortgage pay down? Like, how much are you paying down being leveraged a year?
It's about $2,200, right, a year.
2,200.
Yeah. So when you total that all up, it's around 25,000, right? And if you look at the initial refinancing, you're getting 70% back of the 175,000 ARV appraisal value, right? So you're going to get 22,500 there, and plus the the closing cost is, we'll say 2,000, so you're for 25. And then this is about 25. So in this case here, this is something we're really proud of here. It's about 100% return on investment.
That's amazing. So 100% return. You're making $25,000 a year roughly with your mortgage pay down, your cash flow, your appreciation, and you're left with 25 grand essentially of your own money from the beginning. So you've got 100% appreciation, all still in US dollars.
It's good stuff. I mean, this is obviously, we can't guarantee this on every deal, but this is what we aim for. And, our experience of where we are today in our growth enables us to figure out the factors to make this work, right? That's why we're so selective on the properties we choose. We learned along the way that it takes a certain recipe for this to work. It's going to be the square footage, the number of bedrooms. And most importantly, it has to have the right renovation finish. If you could throw a marble counter in the kitchen, a granite counter on there, it makes a huge difference with the appraisal value, right? So we've grown, we've learned. And we have a really good track record of making these numbers hit. So it's a really exciting time for us and for our investors to be able to scale.
Absolutely. So what are the risks? What are the downsides? What are the potential downsides? I mean, we all know what happened in 08 and 09 and Detroit being super affected, as well as the rest of the US. What are some of the risks? Because ultimately everything has pros and cons, right?
It does. So we try to mitigate a lot of that. Obviously, is non-payment of rent is a huge one. Detroit and a lot of the U.S. markets during the best of times have a pretty medium batting average of people actually paying. We've tried to eliminate that with the U.S. government rental program, Section 8. So I don't know if your viewers know, but there's about 14 million Americans who receive their rent through a subsidized rental program. Okay, that is a huge factor for us. If you can imagine what's happened throughout COVID and in the moratoriums on evictions and non-payment, it's enabled us to grow as a company. And most importantly, we pay out every month to our investors. So that's a risk that we've taken away. Certainly, the risk would be as well that maybe the the appraisal doesn't hit where we say it could, and there could be, we do all the due diligence we can do and the renovations to, but this is not guaranteed that we can say, okay, 100% this is going to hit 175. The appraiser could be having a bad day, but we would fight it if that was the case. So obviously there's the risk of that. The U.S. market can be a little bit dicey with what's going on right now. It's super hot in Detroit. We have tried to do our very best to really curate and hedge against recession or downturn by the quality of neighborhood. If you look historically at the neighborhoods where we're buying properties and renovating through difficult times, they've held their value pretty well. And we're still dealing with properties here that are at half construction cost, right? So it's unbelievable what you're getting. If you come down there and you see these properties, whether it's in Cleveland, Ohio, or wherever your investors are investing, you can go into these neighborhoods and you'd be blown away by what you're getting for the price. It really is, it's amazing. So with some of these products that we have and the quality of renovation, there's not a lot of movement for it to go but up, right? So, I guess the last piece of risk I would say is unplanned maintenance. I've had a few clients where I've had to call, we've had to do a dig 60 feet out in the backyard to dig up a tree root that we didn't know. And things happen, it's real estate, pipes break, as we all know, things go down, but we do a lot of work through property inspection and construction. So for the most part, when you take away the risk of non-payment of rent and we take our expertise of construction, it goes quite smoothly for our investors.
Awesome. All right. So some level of risks, to weigh out. Yeah. Somebody that wants to go and buy something similar in Detroit, what's the capital needed upfront for the majority of them? I mean, obviously in this one, it was the purchase price plus the closing costs, but in general, what are the prices?
If you want to get this strategy, right, the best way to go is cash, because you're going to be able to get the full equity on the refi, right? If you go with a mortgage, it's not going to be the same play. You're going to, for this style of investing to work, the price range really starts. The minimum would be 135,000 USD, and it runs up to 175,000, right? It needs to be in the right neighborhood. It needs to be the right square footage. It needs to have the right renovation budget. And in today's market, that's the range of what it costs, right? It's more expensive for companies like ours or other companies to acquire these properties unrenovated in these neighborhoods. They're really hot. It's definitely a seller's market.
Yeah, absolutely. So it sounds like a great opportunity with some levels of risk, but they're mitigated, I think, by many of the things that you mentioned. And 100% return is obviously a great return. 130,000-ish, give or take, sounds like the investment and capital needed. Now, just to make sure that we're all understanding, we're all on the same page. This 145 included the renovations, and right. It's essentially given as a turnkey type of property. So if you hear turnkey properties, that's essentially what that is. So somebody's doing the renos. In this case, you guys are doing it. So you buy it for a little bit less. You add the reno costs. You add a little bit of profit. Obviously, you're in a business. And then you pass it on knowing what the after repair value is going to be for that person. And once they say, okay, I'm good, they buy that at 145, and you guys go to work essentially.
I couldn't have said it better myself, sir. That's exactly the business model. We're acquiring these properties at a price, and you're looking at numbers like this. It's not that hard to figure it out. We're picking them up at $75,000, $80,000. We're putting in $40,000 to $50,000 in renovations, and then we're putting a 10% profit to run a company. That's our business model. From there, we have property management, which really just kind of pays for itself and the staff. And we're able to pick up in quantity because of our buying power and the fact that we control construction, where we can put a level of finish in it, still make money, and then pass it over to you with equity, right? And with the base LTV being what it is in the States, it's such a huge plus for us to be able to do that, because it allows you to raise the LTV with the equity lift, where you can get a higher percentage of your money back to do what we all love, which is just to scale and get more of them.
Thanks very much, James. That was amazing. I really appreciate you being on the show.
Thank you so much for having me, Sarah. As always, it's a pleasure to see you.
Amazing. And you at home, thanks for tuning in. Don't go anywhere. We'll be right back. Same day, same time next week. See you soon.